Hello, I am Larry Kochard, CIO of the University of Virginia Investment Management Company, and we're here today at the University of Virginia's Investment Conference, sponsored by the Darden School of Business. And I'm here with three distinguished chief investment officers of other endowments and foundations, and I want to briefly touch on the topic of, is the endowment model broken? There's been a lot of articles recently in the newspaper about that, despite the fact that a number of the institutions that are represented here, as well as other institutions, have developed very good returns over 10, 20 years. To my left is Ellen Shuman, who was with Carnegie Corp in New York, a $3 billion nonprofit that she managed for 14 years. Don Lindsey, to her left, was at UVA years ago as well, and is now at George Washington University, where he's been there for a decade. And then Scott Malpass, over to the far left, who's been at Notre Dame for almost 25 years as CIO. And all of these individuals have had a very distinguished investment record. So that's the topic, is endowments. There's been a lot of articles saying that smaller institutions have done well, despite the fact, again, that you've done well over a long period of time. I'm going to start with you, Ellen. The Yale model is how this is usually referred to.
Right.
You worked at Yale before you were at Carnegie. How do you, first of all, define the endowment model?
So I think the whole issue of this endowment model has been way overblown, because to me it's a very simple concept. We're all just trying to find inefficiencies in markets and find smart managers that can identify and exploit these inefficiencies. And they might be in public markets, they might be in private markets, they're in a wide range of geographies and asset classes. So this idea that you've got to have lots of alternatives in your portfolio necessarily to invest and generate excess returns, I think is probably something that is an output of looking for inefficiencies, but it's not an end in itself. And I think everyone's gotten overblown about alternatives being an end in themselves.
Agreed. Scott, you've been doing this for, again, over 25 years. I know, you've been very successful. How would you define the endowment model and why it continues to work for you at Notre Dame?
Yeah, I agree with Ellen. The press kind of defined it as having a lot of alternatives, but that's not how we've looked at it. And actually, it actually worked through the crisis. If you look at the data, the median endowment fund was down about 19% for fiscal 09 when the stock market was down 50 and commodities were down 60 and REITs were down, about that as well. So it actually worked very well. And it is a long-term investment focus. It is trying to partner with great investment organizations and people around the world. Deep research based in terms of really thinking about valuations and opportunities and inefficiencies. And so all of that, to me, is what the endowment model is. And it also has great balance. I think that's part of it, too. Just really strong diversification and really good balance in the portfolio.
Agreed. Don, I know we just heard a talk from Jason Trennert, who talked about his view that public equities there's no alternative to public equities. I know you've been a big believer in U.S. public equities. Talk a little bit about some of the things that you're doing.
Yeah, I'm a big believer in this environment to keep it simple. And on the whole concept of endowment model, it shouldn't be the endowment model. It should be, what is my endowment model, meaning what is the right approach for my school? Look at the liabilities. Look at how much cash the school has on the balance sheet, how much debt they have to service. All that goes into the asset allocation. For us, only 7.5% of our budget at George Washington University is funded by endowment spending. So I can take a very long-term view, accept volatility. Volatility is not a problem, and keep it simple. Equities are great. That's the best place to be right now.
Great.
Well, and I think that there's this perception that being diversified into alternatives is going to protect you when there's chaos in the capital markets and all the correlations go to one. And of course, nothing is going to protect you when correlations go to one, except for government bonds. But if we all held lots and lots of government bonds, we are guaranteed of underperforming our financial objective, which is to get a 5% real return, plus or minus. So we've got to take risks. And as Don said, I think we've got to accept a certain amount of volatility, which we can and should do as perpetual life institutions. And use volatility as your friend as opposed to your enemy. That's the way to go.
Agreed. So I would completely agree with you. We're long-term investors. That really is our edge. We can think long-term. We don't have to just match a benchmark and just deviate from the benchmark by small amounts. And ultimately, that's the endowment model as opposed to any large allocation alternatives, which, as you said, is a byproduct oftentimes.
Right. But having said that, I think that a lot of the large endowments, because they have had a lot of alternatives, because they have large staffs that are doing deep research and are in a fair number of illiquid investments, they have not had broad equity exposure. And of course, post-financial crisis, guess what? Equities have done really, really well. So institutions that have been maybe less diversified or not had a lot of hedge funds, because of course hedges don't work when the market goes up for 5 years. So, that is, we're in this period of maybe sort of an odd time frame where equities have just done so well for 5 years.
Yeah, that's why I'm a big believer in the generalist model.
Yeah.
Because I don't think you want to put people in a box of, I'm just going to look at hedge funds, I'm just going to look at private equity. That becomes self-perpetuating. People feel they have to fill that allocation.
Yeah.
Have everybody forget about looking at what Wall Street's selling, what the consultants are pushing. Just get out there and find out where the growth opportunities, figure out how to invest in it, either on the equity side or debt side.
Well, thank you. I think in 5 to 6 minutes we've defined the endowment model, and I know again that you've all been very successful, and I look forward to what you're doing in the future.
Thanks a lot. It's
Thank
fun to
you,
be here
Larry.
today.
Thanks, Larry.
It was
Thank you for
good
having us at
conversation.
the
And,
conference.
Good to be here.